Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through all the market noise. Today, we are putting a cybersecurity mega deal under a high-powered microscope. Palo Alto Networks is shelling out billions, and I mean billions of dollars to buy CyberArk. Our job here is to stress test the entire blueprint. We need to kick the tires on the financials and really figure out if this is a brilliant strategic move to build an absolutely impenetrable market fortress, or if it's just a risky gamble that could come crashing down under its own immense weight. So let's get right to it. That's really the ultimate question in today's brutal market, isn't it? Especially in cybersecurity. You don't get any points for second place. It's a zero-sum game. You either build something that truly cannot be broken, or you're just waiting for the inevitable breach that's going to take you down. Palo Alto Networks is making a massive definitive statement with this move. They're not just expanding their territory a little bit. No, they're trying to build a castle so high and so strong that no competitor could even dream of scaling its walls. This is about creating a moat so wide that customers have absolutely no reason to even look elsewhere, let alone leave. So you're telling me this is more than just a simple acquisition. This is a pure power play. They've scanned the entire landscape, saw that CyberArk's wall, their specialty in identity security, was way stronger than their own, and just decided it was cheaper to buy it than to eventually get beaten by it. That is an aggressive, almost predatory move. But talk is cheap. Ambition and fancy blueprints don't move a share price for very long. Let's see the hard numbers. Let's see the deal itself. What's the actual price tag on this brand new fortress? Okay, let's get into the guts of this thing. On February 12, 2026, Palo Alto Networks didn't just make a move, they made a statement. This was not some minor tech tuck-in, not some small acquisition you read about on page 6. They went out and they bought a recognized leader in a critical, high-growth arena, identity security. The message they're sending couldn't be clearer. It is way faster and far more effective to just buy the market leader than to burn through mountains of cash for years, trying, and maybe failing, to build a competitor from scratch. This whole thing is about speed, it's about scale, and it's about shutting out the competition from a vital piece of the security puzzle. The terms here are crystal clear, and honestly, they tell a really interesting story. This is what's called a cash and security deal, which basically means it's a mandatory event. There is no optionality here for CyberArk shareholders. This deal is happening. For every single share of CyberArk, that's ticker CYBR, they're going to get $45 in cash plus 2.2005 shares of Palo Alto Networks stock. Now that structure is really important. It gives the CyberArk shareholders immediate cash right in their pocket, while also giving them continued upside, tying them to the future success of this new combined company. Palo Alto is essentially telling them, hey, we believe in this fortress we're building so much, we want you inside the walls with us. Okay, so the deal is done. The ink's dry, the stock has been delisted, it's off the market. The plan was approved by shareholders months ago. But you know what? A plan is one thing, and execution, well, that's a whole other beast. We have seen plenty of these so-called synergistic mega mergers just completely blow up on the launchpad. They look fantastic in a press release, but in reality, they become an absolute nightmare of clashing company cultures and impossible tech integration problems. So the real question is, can Palo Alto actually handle this heavy lifting? Before we even begin to talk strategy, let's dig into their financials. Is their foundation actually strong enough to support all of this new weight? That is exactly the right question. Before you build up, you have got to look down. You have to inspect the load-bearing columns of the business. So that's what we're going to do. We're going to dig deep into their latest Q2 2026 earnings report to see if that foundation is truly solid rock or just sand. And we're not just looking at the headline numbers here. We're looking for the quality of that foundation, the cash flow, the margins, the growth engine that powers the whole thing. We're looking for strength, for sure, but we're also hunting for any pre-existing cracks that this massive new deal could potentially expose and make much, much worse. So let's start with the top line, the raw financial power. In fiscal Q2 of 2026, their revenue came in at $2.6 billion. Just let that sink in for a moment. On an annualized basis, that's over a $10 billion run rate. This isn't some hot startup with a cool idea. This is a financial juggernaut in the cybersecurity space. This is the kind of revenue that gives you the power, the resources, and the flexibility to make these massive, landscape-altering moves like the CyberArk acquisition. This is the financial firepower we are talking about. And you know that $10 billion machine? It is not standing still. Not at all. It's growing at a solid 15% year over year. Now, in this economic environment, hitting double-digit growth at this kind of scale is a huge testament to their execution and their market position. It tells you that their core business, the existing fortress, is not just stable, but it's actively expanding and it's taking market share. That growth provides the crucial buffer you need to absorb the costs, the headaches, and the inevitable complexities of a massive integration like this one. Now, here's where the story gets really compelling. And what's really interesting about this slide, it's the margin. Look at that. Non-GAAP operating margins are north of 30%. This is not growth for the sake of growth, just burning cash to buy revenue. No, this is highly profitable, high-quality growth. This company isn't just growing, it's an absolute cash-generating machine. And that heavy, predictable cash flow, that's the lifeblood of any company that's undertaking a massive project like this. It's the difference between having the resources to solve the inevitable problems that will pop up and being completely crippled by them. Okay, the numbers are strong. I'll give you that. You've got a revenue juggernaut, solid double-digit growth, and some really fat margins. Even the sophisticated models over at Investing Pro are flashing a good performance score. So the foundation seems robust. But, that just raises another, even more critical question. If your house is already so strong, why are you taking on such a massive and incredibly risky renovation? A strong foundation is absolutely useless if the blueprint itself is flawed. What's the strategic emergency here that justifies spending billions and billions of dollars to buy CyberArk? The strategic rationale boils down to one critical word: platformization. The entire strategy, the entire thesis for this deal hinges on that single concept. You see, in today's threat landscape, Chief Information Security Officers, the CISOs, they're drowning in complexity. They're juggling dozens of different point solutions from dozens of different vendors. It is a management nightmare. They don't want a patchwork of different walls. They want one single, unified fortress with a single command center to run it all. Palo Alto is betting the farm that the future of cybersecurity isn't about having the best firewall or the best endpoint protection in isolation. It's about having the best integrated platform. And this slide right here perfectly illustrates the blueprint. This isn't just about buying CyberArk's existing revenue stream. No, look at that first bullet point. They see $1 billion opportunity in new annual recurring revenue. How are they going to do that? By integrating CyberArk's specialty, identity security, and then cross-selling it to their massive existing customer base. The goal here is to take CyberArk's best-in-class technology and just plug it directly into Palo Alto's massive, world-class sales and marketing engine, their go-to-market machine, and scale it across the globe. A single platform sounds great on a PowerPoint slide, but let me tell you, integration is where these mega deals go to die. It's the heavy lifting that breaks companies. I've read their own SEC filings. They list the risks in black and white for anyone who actually cares to look. Unanticipated difficulties, failure to retain key personnel, and disruption of management time. These are all cited as major risks. And these aren't just boilerplate legal warnings, they are the ghosts of failed mergers past. You can't just bolt a new wing onto a castle and just expect all the plumbing to magically work. All this heavy lifting could crack the very foundation they're trying to build on. That's a fair point. Execution really is everything. That integration risk is the single biggest variable in this entire equation. So let's bring in the third-party inspectors. What does Wall Street think? I mean, these are the analysts who spend their entire careers scrutinizing balance sheets and strategic roadmaps. We have compiled the ratings from 22 of these analysts who have put this very deal under their own microscope. Let's see what they have to say. So at first glance, it looks like the market absolutely loves the plan. The sentiment is overwhelmingly positive. You've got 19 out of 22 analysts, that's nearly 87%, in either the bullish or somewhat bullish camp. Only one is even somewhat bearish, and a flat zero are outright bearish on the deal. The market clearly sees the strategic logic. They see the power of platformization, and they believe Palo Alto has the financial strength to actually pull it off. The consensus looks really strong. Overwhelming? Maybe, but it's not unanimous. And averages are dangerous things. They hide all the important details. I mean, an average of 100 degrees and 0 degrees is a comfortable 50, but you wouldn't want to live in either of those extremes, right? That $226 average price target just smooths over some really serious disagreements among these inspectors. There are cracks in that consensus, and if you look closely, some of the most respected inspectors on the street are flagging some major concerns about the structural integrity of this whole plan. And right here are the cracks I am talking about. Just look at this divergence. It's incredible. You have Piper Sandler, and they're raising their target way up to a high of $265. They see massive upside from this deal. They are all in on the fortress thesis. But At the exact same time, you have Mizuho lowering their target down to 205. And even more importantly, you've got HSBC holding firm on a reduced rating with a price target of just $157. Now, that is a $108 spread between the high and the low-end verdict on the exact same set of facts. That's not a hairline crack. That is a chasm in opinion. It tells me that the execution risk that we just talked about is very, very real, and it is making some of the smartest people on the street extremely nervous.
Okay, so we've seen the plan, we have stress tested the foundation, and we've reviewed the conflicting inspection reports from the street. So now it is time to lay out the final blueprint and weigh the potential reward against that very, very real risk. Is this a masterstroke of corporate strategy that's going to mint money for years and years to come? Or is it a massive gamble that could permanently impair shareholder value? Let's break it down.
On one hand, the opportunity here is just immense. The prize for success is nothing less than creating the undisputed, dominant, unified security platform on the market today. We are talking about the potential to add over $1 billion in new, high-margin recurring revenue. And look at that long-term goal. They have laid out a very clear path to a staggering 40% free cash flow margin by fiscal year 2028. The synergy of plugging CyberArk's technology into Palo Alto's sales machine is obvious, and it's incredibly lucrative, if they can get it right. But on the other hand, the risk is absolutely enormous. This path to profitability that they've laid out, it's paved with potential failures. Step 1, integrate, is the single most dangerous step of them all. That's where the spreadsheets and the promises meet cold, hard reality. We have seen deals just like this cripple companies when different engineering cultures start to clash, when the sales teams fight over commissions, and when the key talent from the acquired company just gets frustrated and walks right out the door. The risks they list in their own SEC filings, those are real-world scenarios that can lead to catastrophic failure. A stumble on step 1 means they never even get a chance to try steps 2, 3, and 4.
And that right there is the multi-billion-dollar question. The numbers clearly show they have the financial strength. The strategy shows they have the vision. The blueprint is undeniably ambitious, and the potential reward is total market domination. But, as the Skeptic has rightly pointed out, the risks of execution are significant, and even the experts on Wall Street are deeply divided on this. So only time is going to tell if management has the skill to forge these two powerful companies into one single unbreakable fortress. The foundation is solid, but the really heavy lifting is just beginning. Thanks for joining us here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.